Hey everybody, so Ty Lasater here. We're back on the Growth Factor with our sixth episode. Myself, Ty Lasater, founding partner of Lasater Capital, and co-partner with my brother Boone Lasater. And I function as our CEO. He functions as our CFO, but it's basically a catch-all, as most of you know, when you run your own business, that you're kind of doing a little bit of everything. And I've got our managing director back on here with us, Brian, and Brian works with many of our clients and new clients and onboarding, and he's got a long tenured history in finance and equities and investments, both private and public, alternative platforms and traditional platforms. And so he brings a dynamic input from the questions that he gets currently to opportunities and experiences he has had in the past. And so I know we've been getting, or Brian specifically has been getting a number of questions around the big, beautiful bill. So we're going to focus this episode on some of those common questions that you're getting around the big, beautiful bill, how it impacts us as a business, how it impacts our investors. And we've got about 750 of those. And so how it impacts each of those, how it impacts potential investors, whether active or passive in real estate, and the opportunities that it brings. So with that, Brian, I'll turn that over to you, and maybe let's go back and forth. And what I want to hear is, what are those common questions that you're getting as it pertains to the big beautiful bill, and then I'll chime in on how it impacts us and or our investors. And I know you mentioned. Obviously, we've got a big announcement that Trump is pushing for additionally with the limitations and restrictions around large businesses, large commercial investors coming in and buying single family homes. And so I know I specifically had a question. We've got an investor who's invested with us in the past, and he's investing with us another $500,000. Again, had a conversation with him this morning, and on our 2 hour conversation, it's a lengthy one. He's in the UK, so I don't get to talk to him as much, and I allocated a little bit more time there. But we discussed it at length, and so maybe start introducing some of the questions and those common questions that you get, Brian.
Yeah, thanks, Ty. Good to be here. Yeah, a lot of questions around the big, beautiful bill, just in terms of backdrop. Obviously, a lot of provisions. It was passed into law on July 4th this past summer. No coincidence on the date. It is arguably the most pro real estate piece of legislation that we've seen in many, many years, certainly since before COVID. And it impacted our business in a number of positive ways. There's probably 4 or 5 bullet points on questions that we're getting the most, specifically around how does that impact me as an investor, and also the timing. I would say, just going back to the benefits of real estate, as an asset class, we talk about this a lot. It's created more millionaires and billionaires than any other asset class for a reason. And I love, Warren Buffett quotes, and one of the quotes that he has is, if you're working a traditional job without passive income, you're going to be working until you die. So it's just one more reason to think about real estate and passive income as a way to really generate and build wealth. So let me talk about, again, some of the top questions that we're getting. But back to your point on the most recent news that we've seen posted out on Truth Social. And that's I'll say, an effort by the administration. No laws have been created, nothing has been gone through Congress or anything. It's really just a little noise at this point to prevent large institutional investors from purchasing single family homes. Arguably that's going to impact I won't mention any names. That's going to impact some of the large private equity firms that have bought literally thousands of single family homes. And candidly, a big part of that was post the mortgage crisis. There was a fire sale. And so a lot of these huge private equity firms scooped up housing. The argument for this is it's driving up prices, which is having a related impact of driving up property taxes for people that live in those neighborhoods. We actually have a few houses in the neighborhood next to us that were purchased by private equity, and they're renting them out. And, that's having an impact on some of the neighbors around them. So nothing has passed today, but maybe we can start with that, Ty, and just get your feedback on how you think that impacts the industry as a whole, and specifically for operators like us.
Yeah, I think as a whole, first of all, I think it's a great thing. And that's coming from a fellow real estate investor that owns about 800 single family homes. So, you mentioned it's really going to impact some of the bigger, largest private equity providers in the United States, and that is accurate. There's, you can go look and find articles real quick. I'm again not gonna to mention any names, but it may have a color and a earth stone that it ends with. But they'll go in and they'll buy hundreds of homes in a submarket or in a neighborhood, and this is a maybe unique to real estate, but this is a practice that has been done for dozens and dozens of years. Not necessarily in the single family home market, but in real estate as a whole, where an operator will go in, acquire an asset where they've got multiple assets, and then one of those assets, they will trade that asset from one of their investment funds to another investment fund entity, and they'll do that at a pushed market rate. They'll go in and they'll pay over market for it. And what that does is that drives the market up. And what that does is twofold. Number one, it boosts their balance sheet significantly. So I'll use an example here. Let's say that an operator goes in and buys 100 single family homes in a neighborhood where there's 500 homes. So they own 20% of the homes in that neighborhood. And then they go in and of those 100 homes, they then sell 10 of them to a new entity that they own. But let's say those first 100 homes they bought at, and this is why the average home price across America has increased so much over the last 5 years. They take those 10 homes that where maybe the average of those 100 that they bought was $330,000. And then they sell 10 of them to a new entity that they own and control for $400,000. That resets the market value because of comparable trades. So keep in mind, single family homes are valued based on a comparable analysis, not a cash flow analysis. So, much like you value a business when a private equity company is buying a business, that's how most commercial real estate is valued. How much net income does that business create or that property create? And then there's an exit multiple based on whatever that NOI is. Well, with single families, it's purely about what did the neighbor house sell for, or what did another house in the market, the neighborhood sell for. And so when they sell those 10, that is enough in that market to reset market rate. And so they have an average of $330,000 that they purchased those 100 homes for, and then they just sold 10 to a new entity for 400,000. Yes, that new entity overpaid for those 10, but that new entity then gets acquired by the original entity to make up, and the original entity now has all 100 homes back on their balance sheet, and they can now boost the balance sheet to all 100 homes have a value of $400,000. And so they just boosted the value at $70,000 per home across 100 homes. And so it significantly impacts their balance sheet, and it negatively impacts that submarket because now individual homeowners, first-time home buyers, families that are looking to buy a home now go from looking at homes and expecting to spend $330,000 to $400,000 now. And that neighborhood and that market is now controlled by private equity who has the liquidity to buy up any new available home in that market, further driving up the value and increasing the demand by controlling the supply. And so, there's I think there's great opportunities for smaller operators like ourselves. There's great opportunities for families. And ultimately, Trump is trying to do what he has said all along that he's trying to do. He's focusing on Main Street, not Wall Street. And I've said this over and over. I've said this on radio. I've said this on TV in the last 6 to 12 months. What Trump is doing is focusing on fixing our Main Street problem first. He has got to make it affordable for the everyday American to live life. And part of living life and the major aspect of that is what they pay for the cost of housing. And if he can control that, then he can start focusing on Wall Street on the back end. And, really at the end of the day, um, 70% of Americans are probably never going to be able to afford their own home, no matter what. And now what we're seeing in the last 5 years is that number, instead of being in the mid to high 60s to 70s, that number's in the mid to high 80s. 80 percentile are not available to or afford their own home. And that is purely because of these large commercial investors buying up thousands of single family homes. And now you say, okay, well, what about the smaller operators that are doing the same thing? We've seen this in the Airbnb space. We've also seen this back in when it was, and we still do this today, but when the rent to own model came out really significantly in housing, we had a number of investors that um, abused the opportunity and abused the lack of legislation around rent to own, not owner finance, but rent to own. And so it significantly impacted that market, and ultimately new legislation came about, and it it structured it where no single entity could own more than, I think it's five rent to owns at a time. And so that makes it to where it's too much of a hassle and too much work for the giant private equity funds to come in and operate in that space. But it creates an opportunity for entrepreneurs, for young investors, for smaller owner operators to still operate in that space. As an example, Boone and I still own a number of rent to own properties that we have tenants that paid a non-refundable option deposit to live in. They pay a monthly payment. Part of it will go towards principal reduction if and when they close on their own permanent financing. And what we have to do is every time we have an entity that ends up with five properties, we have to open a new entity and then a new entity. Not too much work for a small owner operator like ourselves, but a large hedge fund is not going to do that. So I suspect that by the time some legislation and maybe a bill gets initiated around this, it's going to have some nuances like that in it, where it's going to limit the operators that are coming in trying to buy hundreds or thousands of single family homes at a time. But at the end of the day, because of the wage issues in America, and because we've got a competitive jobs market, you're still going to have a significant portion of America that either can't afford their own home or they want flexibility and they like to rent. I myself, I don't mind renting. I would rather invest in a property that is going to produce income for me than buying my own primary residence, or three of them, whatever the case may be. I would rather have three rentals in different places in the United States that I can utilize at any given time than having the cost of owning my own home sometimes. And so what that will do then is create a scenario where smaller owner operators can still go out and buy 10, 12, 15 single family homes that they're going to rent out and provide that safe, secure place to live for the families that either choose not to or are not affordable to buy their own home. And so I think we'll still see that. And it's still going to we're still going to see a huge demand in the multifamily space, which we've always seen.
And there are a lot of guardrails from the bottom up as well. Our community, we have a small HOA community. We actually just passed a provision a year ago to prevent institutional investors from coming in and purchasing in our neighborhoods. So you're finding some of those controls also working their way up into the system for those areas that are HOA friendly. Certain states
That's
are
a good
putting.
point. How I'm curious. So we've seen that in the Airbnb space. I personally, through a number of our entities, have owned 25 or 50 Airbnbs that ultimately we either converted to a traditional long-term rental or we sold because of those same structures where a neighborhood HOA or a city ordinance started mandating minimum 30-day leases. But I'm curious how your HOA has, or what the HOA has implemented in order to restrict the purchase alone from institutional investors.
Yeah, I think, well, this is the structure in our neighborhood. If you own the house for at least a year, then you can rent it, but you had to own it. So you owned it, lived in it, moved to another property, and then you wanted to rent it out. That's okay. It's someone coming in and purchasing the property for the sole purpose of using it as a short-term rental. Institutional investors, there's a grandfather. So we're not saying, hey, if it was owned previously and we updated the
Yeah,
rule, I suppose you could put that provision in, but it's a grandfather. So it's no
got it.
new institutional investors moving forward. So I think there's different flavors that you can attach to that within the
So
rule.
that's similar to some condo associations that I've seen, very similar structure there. I like that. I think that's a good unique aspect. I know some of the condos in Texas do that. You've got Florida back in prior to the subprime crisis, overdeveloped condos, and they can't really implement those restrictions because they can't even fill up the condo complexes as it
Right,
is. So and
right.
we've seen institutional investors come in and buy an entire condo complex and convert it to an apartment complex. But anyways, no, that's a unique aspect.
Yeah, well, that's great information. More to come. Obviously, we'll be watching the news and social feeds closely to see what happens with that. But why don't we pivot over to kind of the main topic, the big beautiful bill? Obviously, a lot of very pro real estate provisions that are in there. I'm probably getting five top questions in this order. The number one is bonus depreciation, right? So depreciation expenses. That's coming in a lot. What was set to happen? And what's now going to happen moving forward. That's been a big one. There are some provisions around low income housing tax credits, the LIHTC tax credits. Qualified business income deductions is another one that we're hearing a little bit about, along with new market tax credits. Not germane specifically to real estate, but the SALT deductions, that's, you could argue, controversial on the ability to deduct local and state income taxes from federal income taxes. There were some provisions around that to extend it. And probably one of the bigger ones are opportunity zones. We've been in OZ1, that was scheduled to somewhat expire. And now with OZ2, there are new provisions beginning in 2027 for rolling 10-year periods. That's going to extend that as well, with a few small changes as well. But why don't we talk about depreciation? Because that's really a big advantage for investors in real estate. We always talk about the need to look at your after-tax return and not just return of the investment. But can you share a little bit about depreciation deductions within real estate?
Yeah, well, I mean, depreciation and depreciation deductions are huge in what we do. And I was again having conversation with the former investor who's investing again with us this morning that he's out of the UK, and he was just laughing at how he said I don't think I could. He said I couldn't get 100 of our local real estate investors together to petition their government to implement the same depreciation strategies that we have. And I was laughing. I said, well, at the end of the day, our politicians all invest in one of two things, real estate or oil and gas. And so they write legislation around what is beneficial to those two investment classes. And so we get the benefit of that. And so, we were looking at seeing 100% bonus depreciation going away, and it was going to go down to, I think, 40%.
Yep.
And so that's a huge impact because it, the way the way that we structure our funds, the depreciation benefits our investor. Most operators, there's a lot of operators out there, specifically a lot of the large hedge funds that create a REIT where they don't pass through the tax benefits, the depreciation to their investors. So their investors are ultimately investing in a roundabout way in real estate, but they're doing so without getting the most economically beneficial aspect of real estate, which is the tax benefits. And so what we do is we pass the depreciation through to our investors. And so when you invest, you're going to you make your original investment. We're going to go in and we're going to deploy a capital expenditure plan. Once we're done with the CapEx plan and bringing the value of the property up and we lease it up, we're going to start generating some form of cash flow depending on where debt levels are at the time and where interest rates are at the time. So, number one, any depreciation offsets whatever cash flow is distributed to investors. Number one. In the instance where you're early on in the phase, where you don't have cash flow because you're doing the capex and you're doing the value add to the property, you're going to have significant losses, and those losses can do one of two things. One, if you're an active real estate investor yourself, which I would venture to say 30% of our investors have their own, that 30% of our passive investors that invest with us also have their own active real estate investments themselves. And in fact, the one that I was talking to this morning, he actively invests in the UK, and is deploying his own capital there in the UK, and he also deploys his liquid capital in other operators and in other investment opportunities, which many of our investors do. And so, in that circumstance, you can take those losses and offset any other income that you have, whether it's some form of W-2 income, 1099 income, or anything else. When you're a full-time real estate professional, you can take the losses that are generated early on and apply it to other income, ordinary income that you have. Okay. Now let's assume that you're not a full-time real estate investor and you're purely passive. Maybe, I can think of a couple of our clients. We've got an entrepreneur that we've got a bunch of entrepreneurs, but we've got a number of them that are in the anywhere from 800 to a million and a half a year in income, active income. And they've got a significant net worth, that they're not full-time real estate professionals. And so they can't take those passive losses immediately against other income. But what they can do is they can defer that loss to the next year and the next year and the next year. And then when we go to exit that property and there's a capital gains, they can adjust their basis so that their capital gains is reduced. The amount of taxes that they're paying is significantly reduced because their basis has been adjusted and the capital gains that they have that they're reporting from a tax perspective is less. And so here in America, the capital gains tax is capped at what, 20%. And so when you adjust your basis for the loss carryover that you haven't taken, then your net effect or your net capital gains is going to be in the 12 to 14% range instead of 20% because you're reducing your overall basis. And so depreciation has a huge impact. And if that is significantly reduced to where you can only take that depreciation over, call it a 27 and a half year period and take it equally each year, and we don't have the aggressive depreciation methods that we can use or accelerated depreciation methods that we can use on the front end, then our overall tax impact and effect for investors wide, whether you are a full-time real estate professional or not, are going to be significantly impacted. And those who are not full-time real estate professionals, their net impact, they're going to be closer to the 20% range on long-term capital gains, and it's not going to be affected. And then for those that are full-time real estate professionals like myself and the other operators, then we're not going to be able to use as much of a loss against other income. So in the circumstance where typically when you're a net buyer and you're buying assets and you've got accelerated depreciation, you're going to offset any income that you're going to have against exits or sales that you have. But in a year where you're even a net buyer, and let's say you acquire 3 assets and sell 1, you're still going to have a significant tax impact because you have far less depreciation that you can take in that first year.
And so, Ty, we've gotten this question a little bit as well. Well, what if my depreciation exceeds my passive income, say in the first year or two, which that can happen? am I able to carry that forward and reduce future tax year liabilities?
Yeah, that's so I introduced that a little bit a minute ago, and that's absolutely that is typically the case. So when we have um, bonus depreciation and accelerated depreciation, where we can typically, like as it stands right now, we're able to depreciate about 70% of an asset in the first year or 2 years. By the end of the second year, we're at about 80% depreciated. And so obviously in that circumstance, depreciation and losses are going to far exceed any income or any distributions that are made. Let's
Right.
let's say let's say that and I have the most cash flow that I've had on a property in a given year, just passive cash flow, is about 12%. I've been able to make 12% distributions, and that's on dollars invested. So if somebody invested $1 million, they saw $120,000 in distributions that year. Well, depreciation far exceeded that. Depreciation was more than quadruple that. And so they
Hmm.
were still able to write off all of their distributions and have additional losses to carry over into the next year or the next year. And so the way that ended up working out is you you take the depreciation and it reduces your basis. So ultimately, it shows a reduced basis in the asset on your taxable balance sheet. And this is from a tax perspective only, right? It
Right.
reduces your investable basis. And so the way that depreciation recapture happens is you've got to add back all the depreciation that you've taken at the year of exit. And so now when we're exiting, we arbitrarily increase our basis in the property from a tax perspective. And so the overall capital gains is limited and reduced. And so that carryover that you're not able to utilize against other income goes to reduce that taxable gain at the year of exit.
And that's a great feature. Again, if you are a common public markets investor, whether that's real estate or even other asset classes, that's a provision that's not always available or just flat out not available. So again, we always look at the benefit of after tax returns and really the need as an investor to look at that total benefit. We talk about inflation, we talk about after tax returns, we talk about behavioral decisions and investments, but that is one of the huge advantages that real estate provides as an investor. So
Yeah, absolutely. It's unique in real estate. Real estate and oil and gas is this way as well. Now, oil and gas, your number of positive outcomes versus negative outcomes is much smaller than it is in real estate. So in real estate, you're going to have, 10 to 20% if you look at any operator that has been in business for 20 plus years, they're going to have 10 to 20% of their portfolio that has experienced a loss, right? You're not going to bat 1,000. So I've done roughly 30 multifamily properties and I've done over 800 single family homes. And I can go back to, right now, I think we've executed on and finalized three losses in totality across that large portfolio. And so if you look at any operator that has experienced a loss in real estate and compare that with oil and gas, you're going to hit 8 or 9 out of 10 dry holes. And then out of every 10, you're going to hit one or two that hit. Now, those one or two that hit have a much
mm,
higher return metric than your real estate typically does, your real estate deal. But in real estate, you're going to have 8 out of 10 that hit and 1 or 2 out of 10 that don't. That's kind of the difference. But in real estate, your return metrics is a little bit lower. So it's a little bit more it's quite a bit more conservative than oil and gas. But the overall return metric is a little bit less on those that do work out. So as it stands in real estate, the way the tax is beneficial is that if if you did 5 equal deals, every deal was the exact same as far as dollars invested, return potential, and risk profile. And out of those 5, one of them failed the risk profile and the other four hit positive, and you exited on your business thesis. And so let's say each one of them had a you had $1 million exposure. It was $1 million that was invested, and maybe you had, $2 million of debt. So it's a small $3 million deal. Okay. And so $1 million of exposure. And on that fifth one, you lost $1 million. Those other four are going to more than make up the million, and you're going to average out somewhere between 12 and 15% return across the five, even with a fifth one being a complete loss. And that's kind of how real estate plays out. And that's because of the taxes, the tax advantages. So you can take that $1 million loss and apply it to the gains of the other four on top of the depreciation. And that $1 million loss is going to equate to more than $1 million of tax benefits across the other four. You're going to end up with about $1.5 million worth of tax benefits from that $1 million loss. And so net net, it ends up in a huge benefit. And so that's one of the reasons that we do, instead of single asset syndications, we do a fund. So in single syndications where a single asset is purchased, there may be one or two, or you may have a handful of investors that are only in that one deal, and that deal is a loss. But then your other four deals become a net positive. Whereas we do a fund and we'll acquire multiple deals. So if one of them is a loss and the other four are positive, we are all taking participation in each of those, and we're spreading out our risk profile across that portfolio. So there's a huge benefit to that, really, that loss carryover. And typically what I've seen, and even in my circumstance, where in my best year, where I had a high seven-figure reportable income, I was able to fully write that income off with the depreciation losses that carried across to, because I'm a full-time real estate professional, it was able to carry across to each of our deals. And so I was able to fully write that off and still have a little bit of depreciation to carry over into the following year.
No, that's great. And actually, speaking of being able to carry those depreciations into the first couple of years, if we have time, we'll talk about a strategy that we're starting to talk to more clients about, where you can actually take existing IRA dollars, move those into a vehicle, a Roth IRA, and take advantage of that from a tax standpoint as well. A little bit of tax arbitrage. It's been a very powerful strategy that not many investors know about. So let's shift gears a little bit and talk about some of the provisions to help out from housing and affordability standpoint. One of those is the low income housing tax credit. So the LIHTC credit. We have had some properties with LIHTC in it. Some of those may expire, but there are some new provisions around that just to expand affordable housing for investors. Can you share a little bit about that, Todd?
Yeah, so we have a LIHTC property now. We also have a LURA property, or a land use restriction asset, which is it's very, very similar. And so, those I've said before, that with those, we we typically stay out of some of the blue states because of the legislation and the mandated laws around real estate as it pertains to tenant benefits versus landlord benefits and things like that. And so, at the end of the day, we want to provide a property that gives amazing tenant benefits, a opportunity where our tenants feel safe, secure, and they feel at home. But it's a business, and we've got to be able to have the ability to make sure that we've got good tenants in the property, and we've got the ability to get bad tenants out if and when a circumstance happens. And so, oftentimes we've seen LIHTC and LURA situations in some of the blue states where not only do you have restrictions on rent, but then you have mandates around evictions that make it really tough. So, you're already limiting your asset from a rent perspective or a revenue perspective. And then when you put in place restrictions that that make hurdles to overcome so high that they're unbearable, then we want to stay away from those. But in places, there's places like and our two assets specifically that we have that do have rent restrictions are here in Texas, where most people ha if you talk to most new investors or amateur real estate investors, they have no idea that we have rent restrictions in Texas. But those come in the form of these types of assets, the LIHTCs and the LORAs. And what it is it's an operator voluntarily putting a low income housing tax mandate on the property in exchange for tax benefits of some kind. And so those tend to work when now I won't go into the unique circumstances on this show, this episode, where those wouldn't work. There's situations where here in Texas, if I was looking at a property that I wouldn't buy a LIHTC property, really from a 30,000 foot view where that wouldn't work is, let's say the previous owner elected to take the benefits all up front, and then there's still more than probably a 5 year horizon of those rent restrictions left in place. And the rent restrictions are so restrictive that you're gonna have a very difficult time ever taking that asset to a market rate property.
Right.
One of our properties actually kind of falls in between. And it was a unique circumstance, but previous owner took all of the owner landlord benefits up front, took all the tax benefits up front and now this was the original builder and developer on a 27-year LIHTC. He took all the benefits up front, and then new owner came in, did some value add to the property, which gave him some additional um, tax incentives and tax abatements. So he took those benefits up front. But in doing those additional renovations, he was able to shorten the LIHTC period overall, so that when he sold it to us, there was 5 years of the LIHTC or rent restrictions left in place. So we've got 5 years left in place, but it is a very heavy rent restriction property. And by heavy, I mean half of the property is limited to 50% AMI qualifies. So AMI is average median household income in the area. So in order to qualify to live in this property, or 50% of the property has to focus towards people that make 50% of average household income. And in this area, the average household income is $64,000. In order to qualify, then you have to make $32,000 or less. Well, it just so happens that rent in this area, market rate rent, is about $1,000 a month. So $12,000 a year. Well, in order to be a good qualifying tenant to live in a property that is leasing at $12,000 a year, you need to make $36,000 a year to qualify, 30% of your income to your housing. Well, that is really close to what the 50% AMI number is. And so we've only got to discount rent by about $50 per unit, and we're still falling right in line with market rate rent in that area. So it makes it a really good deal. And so you got unique factors like that make it a benefit. But these low income housing tax credits also, when federal is involved, it gives additional benefits. And so we're going to have benefits from a federal tax perspective that we're going to get to implement and utilize, that originally the original owner and the previous owner took all of the tax benefits, the property tax benefits up front. So this gives us an added boost or an added benefit to that property that we were originally not looking at.
Okay. Very closely related to this is the new markets tax credit. So that was set to expire just a couple of weeks ago at the end of 2025. That's been permanently extended, essentially to encourage investment in low income communities as well. So probably somewhat related and similar response that you provided, but anything else you would add to that?
Yeah, so we've seen a lot of this, and actually, I saw this was real popular coming out of COVID. With the significant migration to red conservative states, both from a business perspective as well as an individual perspective. Coming out of COVID, we saw, I think it was right out of COVID. So it was 2022, I believe it was. We saw 18 Fortune 1000 companies relocate to Dallas, Texas. We saw 20 relocate to Texas. And then since that time, we've still seen it's continued to go up and continued to increase. We've had a number of Fortune 1000 companies continue to move here. Furthermore, you've got these smaller submarkets where, and um, I'll use Elon Musk as an example, right? So he's opening up Tesla. He moved X to Buda, Texas, right? And so that's a small submarket outside of Austin, Texas. So what we're seeing is these significant sized companies. There's another one, a chip manufacturer that moved in and opened up in Sherman, Texas. Sherman, Texas.
Yeah.
I mean, I live in the Dallas Fort Worth metro market. You do too. For us to get to Sherman, Texas, it's a 50-minute drive, right? I
Yeah.
mean, it's north. It's almost to the Oklahoma border. And so it is, maybe somebody from New York looking at the news and on the map, they look at it and say, "Oh, that's Dallas." No, it's not Dallas. It's a significant distance, and driving 70 miles an hour, it's still 45 minutes up there. And so, but it's a great submarket. That chip manufacturer opened up there. It's going to open up 2,000 jobs. Well, Sherman, Texas, maybe had 2,000 jobs in it before that chip manufacturer opened up. So it just doubled the amount of jobs in that market. And so it creates opportunity for new jobs, which means new individuals moving into that market. They're looking to get out of the hustle and bustle of Dallas, looking to get to the suburban home life and move out to where there's good schools for to raise a family in. And so it creates the opportunity for development there. And so what we saw was developers going out and building multifamily in these smaller markets that were well under median household income. Where I mentioned Dallas had a $64,000 median household income. The nation average is like 62,000, I think. Well, you go into some of these submarkets like this, and the median household income is 48 to 52,000. Much sorry, much lower, 48 to 52,000. And so you go in and you develop a property there, and what this new market tax credit bill is doing is incentivizing developers to go in and develop housing where businesses are relocating to and creating jobs in those markets where traditionally they've been lower income markets. And so we're seeing this in Abilene, Texas right now, where we've got a pretty significant footprint. You've got a number of AI companies that are putting in infrastructure. We're seeing $2 billion worth of AI infrastructure going into Abilene, Texas. They're also bringing in the B-22 bomber, which is going to add another 2,000 or 1,800 airmen to the Dyess Air Force Base in Abilene. So between the AI and the Air Force Base, that's bringing about 4,500 to 5,000 new jobs to Abilene, Texas, which has about a 200,000 population, and 300,000 if you look at the major metro there. So there's a small airport. That airport now, it only flew American Eagle, which is a sub of American Airlines, and you could only fly direct to Dallas. And then from DFW, you could catch and go anywhere. Well, they're opening up, I believe it's Delta. Delta is opening up a terminal now, and American Airlines is going to increase their airplane size. So they're going to have direct flights to, I believe it's Phoenix, Dallas, Chicago, Miami. There's about a half a dozen new direct flight locations that you can fly to out of Abilene, and they're adding about $400 million of infrastructure into that airport to make it a much larger airport. So what we're going to see there is the same situation. It's a market where I think median household income is about $51,000, somewhere between $49,000 and $51,000. It's going to create an opportunity for developers like ourselves to go in and start building some infrastructure in multifamily space.
Yeah. Very good. So two other quick ones I think that we're getting a lot of questions on. One is the qualified business income. deduction of 20%. That was also set to expire. That's under 199A. And then let's wrap it up and talk about opportunity zones. There's a lot of excitement, I think, around OZ2 and what that's going to look like moving forward. But maybe spend just a second and talk about the impact of the qualified business income for pass-through organizations.
Yeah, so I'm not a tax professional here. I'm going to answer that on how I see it impact to us. This is one, Boone as our CFO has a little bit more insight there, but this is definitely getting into more tax specific. However, this falls in line with really much like depreciation, with the qualified business income deduction, investors, myself included, when I invest into one of our funds, I use a personal entity, a personal LLC. So I fund a personal investment LLC. That LLC then invests passively into one of our funds. And so, doing that structure, my LLC ends up generating income. But then because that income is from a qualifying business activity, I get to take the benefits of investing in real estate into that business income, which ultimately reduces by 20% the amount of income that business has to pay taxes on. So there's a huge benefit there, just because you're investing in real estate or one of the other qualified business activities that deduction pertains to. So that gives a boost, in the form of when there is reportable income, you get an increased deduction against that income, not even having to utilize the depreciation pass through.
Yeah, and I think it provides a little clarity for the rate ultimately the pass-through organizations are going to pay. I think it's about 20, little over 29% compared to the corporate rate of 21%. So that was going to be a larger delta, and that's getting a little closer today as well. So it makes it a little bit easier, I think, for those smaller organizations, pass-through organizations, to really plan for investments moving forward. So that's a little ancillary benefit that we've heard some feedback on out in the marketplace as well. So let's wrap it up. Talk about opportunity zones. OZ1 was set to expire. OZ2 is going to begin here in just a little less than a year, in January of 2027, with rolling 10-year increments. Nice feature for, again, thinking about the tax advantage of investing in some of these opportunity zones. But I'd love to hear your feedback on just overall your thoughts around opportunity zones and how this may impact overall real estate investments.
Yeah, so this is a unique scenario where I've talked about this before, in that I don't specifically go out and look for opportunity zone properties. Like, I wouldn't go out and say, okay, I've got to deploy, I've got this $10 million, and this $10 million I am only going to deploy into an opportunity zone. I feel like you really limit, you basically put yourself in handcuffs there, and you're not going to be looking at opportunity. You're going to be looking at a way to deploy capital instead of what I'm doing when I'm looking to, when I've got $10 million to deploy, I want I want to say no. I want to say no to the deal. And I get through my first round of pass through underwriting. And if I can't say no, then I go into a deeper dive. And if I am limiting myself to only opportunity zones, then I'm going to jeopardize my internal metric that I've set up, that I start with a no and the deal has to make me say yes. Now I'm saying I'm only deploying in opportunity zones and I've got $10 million to deploy. That $10 million starts burning a hole in my pocket, and I get to a point where I have to jeopardize that plan going forward. And I start saying yes to a deal much quicker than I should. Right. And so that being said, let's move that aside. And now let's say we end up with, and by happenstance, by complete happenstance, we do have a deal right now that is in an opportunity zone. So I'm going to use that as an example. It's a fantastic deal because it is in one of those primary submarkets of Dallas that I was talking about, much like Sherman, but it's got a bigger infrastructure. So we've got a raw land deal in Denton, Texas right now. Denton is a major metro growing area. We've got a international, obviously, as everybody knows, we've got two international airports here in DFW. We've got DFW Airport and we've got Love Field. which both airports fly to multiple locations. Just so happens Love Field is restricted to Southwest Airlines primarily. You can fly a couple of other smaller airlines that are much more like a private style flying, but that's either here nor there. Dallas is growing so much north right now that it's going to have another airport up north of us before long. And it is expected that that's going to be in Denton. Denton has already announced they already have an airport there. It's already announced that they are adding infrastructure to that airport. McKinney, who also has one, has been, it's been back and forth that it may be in McKinney, but McKinney has repeatedly turned that down. City Council has continued to turn that down. They don't want to develop out that airport there any larger than what it already is, which is giving an opportunity to Denton. And if you think about it, Denton is much like it's almost like if you're in that Tri-City area, New York, New Jersey. You've got three airports right there within probably a 40-50 mile radius, right? And so we will ultimately end up with that in DFW. DFW is such a large growing market. There's no other top five market like it in the United States because the other top five markets, if you look at them, Chicago included, even though Chicago is not on the coastline, the ocean coastline, they do have Great Lakes right there, right? And so all of the other major metro cities are 180-degree cities. They cannot grow anymore in one specific direction because of water. Dallas does not have that. So Dallas Fort Worth has already combined into one DFW, and it has been that way for a significant time period. But now Dallas Fort Worth is expanding, and Weatherford is part of DFW now. Terrell is a part of DFW to the east now. Denton is a part of DFW to the north now, and Cleburne is a part of DFW to the south now. And so it's just growing and growing and growing. And so it's growing significantly northbound. You've got McKinney and Frisco, and Keller, which are Northwest ISD. Those three cities are all three in the top 15 fastest growing cities in the nation. And all three of them have the fastest growing school districts in the nation. And all three of them are north of DFW, Dallas Fort Worth, and they border Denton. And Denton is now growing as well in 360 degrees and coming southbound into DFW. And so we're going to end up having a million person population in Denton alone in the next 5 to 10 years. And so Denton, though, has been one of those new market tax credit markets where for the last decade, the median household income in Denton alone has lagged behind DFW by about $10,000. And now it's getting closer and closer, and in circumstances exceeds some areas of DFW because more and more families are moving into Denton. It's not as big as Dallas. You don't have as many schools yet in Dallas. You don't have the drastic dynamic geographical and geopolitical differences within the school systems. And so we're seeing expansion in Denton. Well, Denton just so happens to be, or a significant portion of Denton, an opportunity zone. We bought a vacant raw land. I think originally we bought 18 acres in Denton to develop on. And then about 6 months later, another 5 acres became available. And so within the next 6 months after that, we acquired that additional 5 acres to make it 23 acres of developable land. It ultimately changed what we were going to develop there. It went from a small single family housing development, kind of condo style, to now we're going to be able to have a multifamily aspect to it and some minor commercial aspects as well. And then we had significant inflation on products and goods to develop and construction materials. So we held off on development through that time period. And now we've held that land for a little over 4 years. That land has over then doubled in value just for the land itself. And now we're about to start developing it. And it's in an opportunity zone. So the opportunity zone with a 10-year step down, OZ1 has a 10-year step down. Well, we're already 4 years into that. We're going to develop, which is going to take another 18 months or so. We'll be in year 6. Then we'll want to hold the asset for 3 to 4 years to stabilize it and cash flow. That puts us at the end of that 10-year period before we decide to exit, which means we're going to be able to fully write off the tax impact on that property. And we will not have had to have had a developed project for that entire time. We're letting the value of appreciation because of that market alone add value to the property. And so huge opportunity there that I would not have set back in the beginning and just said, well, we're only going to buy an opportunity zone. And so now, moving forward, and especially as we're looking at, I'm looking at more and more of these submarkets for development where we've got large Fortune 1000 companies relocating to as areas for us to go in and develop in. Well, all of those submarkets have all of those tax benefits that we've been discussing. They have the LIHTCs. They have the opportunity zones. They have the new market tax credits. And so we're going to be able to take advantage of each of those. Not because we're looking for that only, but because first, I'm going to go back to how we look for assets. And I've talked about this in previous episodes. But first, I look for higher education. So when there's higher education around, you take Sherman, for example. Sherman has a small college in it. Then I look for major medical. And then I look for diversity of employer, and I look for major financial. Well, there is a somewhat of an argument that when a large Fortune 1000 company comes in and brings 2,000 jobs to a market that had 2,000 jobs in totality before, that you've got limited diversity of employer. But when you've got one new major employer like that moving in, brand new, there's going to be more to follow it pretty quickly, and you're going to have smaller businesses starting up. So a market that had 2,000 jobs that adds 2,000 and is at 4,000 is going to have another 5,000 or a total of 5,000 via another 1,000 added just from new jobs that come from new businesses being started up. And so those create awesome opportunities. And now I can go to my original business plan of looking for opportunities in markets that have those 4 criteria. But as it stands now with these tax benefits, those type of markets fall within all of those tax benefits or those taxing jurisdictions. And so we'll get the benefit of, first of all, having the market that we want, following the same structure that I've always followed for the last 20 years. And secondly, have the tax benefits that come with it.
That's great. Yeah, just kind of wrapping up our topic of tax abatement and utilizing those strategies. One that we can talk to you about offline and see if this really makes sense for your own individual situation is a way to convert traditional IRA dollars into Roth IRA dollars. And if you're not familiar, Roth IRA essentially is a vehicle that allows you to grow assets tax-free. It's got to be a qualifying event in order for you to get it out. But for the most part, money in that bucket allows you to grow tax-free. And you talked a little bit earlier about the fact that you can depreciate and devalue real estate early on in the process. So a little secret that not a whole lot of investors know about, or they think this is a strategy that's only reserved for the rich and famous or the select few. It actually is available to anyone, and it goes something like this. In order to contribute to a traditional Roth IRA, there are income limitations. And so if you make roughly $250,000 filing married, you're not able to put new money into a Roth. But what a lot of people don't know is you can take existing traditional IRA or traditional 401k dollars and convert that. So a kind of a traditional Roth conversion is you might have an IRA with say $50,000 or $100,000. You convert that. Now you do have to pay taxes when you convert, depending on how much basis and earnings you have in your IRA. You have to pay taxes on that when you convert, but then that money grows tax-free. You can do the same thing. It's called a mega backdoor Roth out of a 401k. You might have $1 million in a 401k. You can convert that into a Roth IRA, and then that money grows tax-free. So it's a vehicle for investors or savers who ordinarily may not be eligible for a Roth to get money into a Roth bucket. Now, you do have to pay tax on the conversion amount, so there is a tax ladder or conversion strategy where you may only want to convert a certain amount each year to keep you under the next tax bracket. But one of the real advantages of investing in real estate, because you can do that devaluation, is you can convert at a lower rate. So just a very, very simplistic example. If you invested, say, $100,000 in your IRA in real estate, in the first couple of years, you could devalue that to say $60,000 or $70,000. At that point, you convert it to a Roth and you pay taxes on that lower amount. And then at that point, it grows tax free. We talked about this earlier. This is how Peter Thiel and others, took a few $1,000s in a Roth IRA and grew that to literally billions of dollars in an IRA. So it's a strategy we can certainly help you with. If you have questions on it, feel free to contact us. We can talk a little bit more about the nuances and the importance of working with a qualified tax expert to see how that works in your own particular situation. So,
Well,
Ty, as we
real
wrap up, a
estate,
lot of
yeah, to add to that real quick, real estate plays a huge benefit and a huge role in that as well because, if you're what we've seen is, let's say an individual has a 401k or a self-directed IRA, and they've had those dollars deployed into the equities market. Um, you can take those dollars out of the equities market, deploy it into that. Let's say somebody's got $1 million self-directed IRA. You got $1 million self-directed IRA, and it's been deployed into equities markets or whatever the case may be, and they want to do this Roth conversion. Okay, so what we can do is take $100,000 out of the equities market, deploy it as a self-directed IRA into real estate.
right.
Then real estate with real estate, the unique thing, and some of our investors, I don't think fully comprehend this. We've got a significant portion of our investors. They've either had their own real estate investments, or they currently have their own real estate investments, or they've invested enough into private investments that they understand this. But we do have a portion that just don't understand this. When we're buying value add real estate, first of all, we have to buy value add real estate typically with a bridge loan, because it's not going to qualify for a long-term permanent financing loan, because you're going to have a devaluation period in the period in which you're implementing CapEx. Most, like a portion of our investors don't understand that. Let's say we acquire a property. We acquire a property for $50 million, and we're going to put $5 million of CapEx into it across, let's say 4 million of that is going to go into interior unit renovations and 1 million is going to go into exterior. The exterior piece doesn't devalue. That immediately adds a little bit of value to the asset. Let's say it needed new roofs. So that $1 million is going to go in and put in new roofs. It's going to do an exterior paint. That takes away deferred maintenance, and it adds a little bit of value, intrinsic value to that asset. The next $4 million, though, is going to go into interior renovations. Well, the only way to execute those interior renovations, which are by and large going to increase the value of the property, not because of the renovations that are done, but because of the rent increases that we can accomplish from the upgrades. So let's say we've got traditional units, and those traditional units are accomplishing $900 a unit in rent in a market where there's upgraded units that are accomplishing $1,050 in rent.
Right.
So about $150 per month increase in rent. What we're going to do is we're going to go in and we're going to do $2,000 worth of unit interior upgrades throughout the entire property. And then that $2,000 upgrade in the property is going to give us the ability to increase rent by $150. We're going to have a number of tenants that don't want to move out, and we're not, because they are willing to stay, we're not going to add $150 to their rent. We're going to add 75. We're going to go up by 50%. But what we're going to do is we're going to have to force vacate 25% of the property day one. And so what we're going to do is we're going to go in and increase rent as rents expire. We're going to increase rent by $150. So a tenant is going to pay $150 more to live in their traditional unit if they want to stay there. And if they do, great. That means we don't have to renovate that unit, and we just accomplish market rate rent. But if they don't want to pay that, they're going to move out and they're going to go rent somewhere else that has a market rate product for the same price. It's going to give us the ability to start doing the value add. Okay, so 25% of the units are going to become vacated. That's going to immediately remove 25% of our income, which is going to devalue the property. We're going to start unit renovations. As we start those unit renovations and as more units become available to increase the rent, we're going to start losing more tenants so that we can force vacancy down to about 60% in totality. So we're going to really get rid of 40% of the tenants. Then as we finish those units and the tenants that want to stay, we're going to move those tenants into the 40% of the units that have been renovated. And we're going to start renovating the next 40% of the units, ultimately leaving 20% of the units at the end that we don't renovate. As we renovate those next 40% of the units, we're going to lease to new tenants at that time. Well, that's going to devalue the property by anywhere from 20 to 40%, which then in turn gives you the opportunity to convert to your Roth at a discounted valuation. So you're not paying as much in taxes on that converted piece.
Right. It's a beautiful strategy. And again, it's something that not a lot of investors know about, but we would encourage you to connect with us and let us share you more examples similar to what you just went over, Ty. So thank you.
Exactly. Well,
So we
thanks
covered a
everybody
lot
for
of,
being on this week. Definitely always enjoy having everybody here for this sixth episode of The Growth Factor. Brian, thanks. You had some great questions. Obviously, we've been getting some good questions. I think in the month of, let's see, it's January the 13th. Thus far in the month of January, you've had already, I think, 19 meetings or something this with potential new investors. And so I know we're seeing quite a bit of capital move now. So if you have questions about anything, then wherever you're watching this, whether it's social media, Instagram, X, LinkedIn, Facebook, comment. We'll respond to your comments in one of those responses. If you want to jump on a call with Brian or myself, we can get you a link to our Calendly. Or if you're watching this on YouTube, definitely comment. We'll try to answer any questions that you have, or definitely jump on a follow-up call. But again, we've got Managing Director Brian Robb on here, who has 30 plus years of experience in the finance space, and myself with 20 plus years in the real estate space and 25 years in finance and accounting. And so definitely look forward to answering any questions that you may have. But thanks again for joining us on this episode of The Growth Factor, and we will see you next time.